It was another extremely volatile week for the markets. Comments from the president about closing the border, as well as the Saudi conflict, worries about growth getting impacted by the Federal Reserve raising interest rates, all impacting investors this week. To my next guest we go for reaction. Bank of America Global Wealth and Chief Investment Officer Chris Hyzy joining us this weekend. It is good to see you.
Good to see you, Maria.
Thanks so much for joining us. So are you worried about all of these things?
You always get worried when you see a pretty sizable fall coming that quickly. We call it a backdraft. It's pretty much a hallmark of a reset. There's a lot of portfolio resets going on between equities and fixed income, and specifically within equities. You're seeing a lot of flow go from the ultra overexposure to growth back into value. Same thing with ultra overexposure to U.S., some of the big high market cap names. Not necessarily to non-U.S., but going down the curve. Cash has gone up. Long duration assets are moving down. So worried from the standpoint of how quickly it happened, but not worried about this is the end of the cycle.
Yeah, and you know, you wouldn't be surprised really when you look at the rates of where we are, because even in the 2-year, for example, and we talked about this last week on this program, if you're going to get close to 3% or 3% from the 2-year note, well, maybe I can say to myself, okay, maybe I take some money out of the stock market and put it in the 2-year because I could get the safety of sleeping at night, and I know that I'm not going to lose money on that.
No question about it. If we put ourselves 3 or 4 years ago, that 2-year yield was close to zero, and the prospects of coming down the curve just simply weren't there. Now you've got a 2-year yield which started out this year competitive to the dividend yield of the S&P. Now the 2-year yield is getting close to 3%, which is competitive to the 10-year yield that we saw, I don't know, a couple weeks ago. So we've gone up 17 basis points in the 10-year yield. And all of a sudden, the world's coming to an end.
Yeah.
Like, it doesn't happen like that overnight.
So would you recommend then putting some money in instruments like that, like a 2-year, just to get that yield? I mean, I don't want to discount the stock market because we're still talking about the backdrop very strong. Right. Earnings have been better than expected. We're expecting 22% earnings growth for the third quarter. That's
right. This is a reset, and the stock market is about total return. The fixed income market, many people have been taught recently, anyway, as rates have come down to record low levels, except for this year, to look at fixed income as total return. But if you think about it, fixed income, by its name, fixed income. Right. So if you're thinking about where you allocate, certainly the low end of the curve is very attractive right now. You have very negative term premium still, or zero term premium. And if you're going to go out duration extra 6-7 years just to pick up 25 basis points, it just doesn't make any sense.
All right. So do you think this has been overdone then? You don't think the cycle is over then? You still want to buy stocks?
Yes. Still want to buy stocks.
There's a but coming.
The but's coming in about 10 seconds. Okay. The first part of this is make sure you are diversified. I know it's an easy thing to say, and we say it all the time, but diversification works when you need it the most, and that's right now. We're heading into a year where the regime shift is happening. We're getting later in the cycle. Rates are grinding higher. Equities, don't be overexposed to any one area. Cash flow, free cash flow, is absolutely critical in this stage, and clean balance sheets. So high quality, and on this weakness, Maria, we want to own this weakness. We want to buy into this weakness if you have cash and liquidity there. If you're fully invested right now, you got to hang on. And you got to reset and rebalance at the end of the year and get ready for a lower return environment. But equities are still more favorable than bonds.
So you said a minute ago there's been a shift, growth to value, growth being the Amazon and the Google parent of the world. I mean, these stocks, Netflix, Tesla. Yeah. Tesla, even though it sold off recently, it's still up 80% year to date. Yeah. Is that what you're talking about when you say growth?
Yeah, I think because of the advent of what have you done for me lately, whether you're a fund manager or if you're in an automated investment program, which has a low break point, meaning low number of dollars that you're needed to get into that program, you're going to go into ETFs. The ETFs own a lot of the high market cap, large cap growth driven companies, so it feeds on itself.
All right, we will leave it there. Chris, that was great advice from you. Thank you.